Hey, Trader Stephen Quitzel here with TradersPlan.com. It's Thursday afternoon. Have a pretty strong day in the market after a few really weak days earlier this week. So before we get started, actually, we're going to look at a lot of stuff today. We're going to look at all the major indices. We're going to look at market breadth, but we're going to do something a little different today. In the middle of earnings season, we're going to pull up an earnings gap up scan that I like to use and just go through it and, just to see what we can find, to see what strong stocks we can find. We're just going to go through the charts one by one. So before we get to that, let me show you some disclosures real quick to make the lawyers happy. Okay, let's start with the Nasdaq. So we have a lot of chop, right? Had a rally right here, rolled over, breakout right here, and it didn't last long at all. The rally is over, and so typically when I see corrections, what I'm looking for coming out is a strong rally, a strong trend, followed by the 20-day EMA. So that's really what I look for, because typically I've seen that strong rallies come out of corrections. A lot of times we'll hold the 20-day moving average for a few weeks, get a nice multi-week rally coming out, because everyone is really ticked off because they lost money in the corrections. So then, of course, that's when the market takes off. And it just didn't happen this time. And, that's just part of it. Whipsaw is a part of trading. But, if you have the rules in place to slowly get in and slowly get out, you don't have to make all or none decisions. If we look at the Nasdaq, you can see you had a reversal right here at the 200-day moving average. Had a outside day right here, right at the 200-day moving average, and it didn't quite come down to that this time, but it did reverse yesterday in below average volume, but it's popping nicely today. Now, a lot of that popping has to do with earnings, and Facebook is gapping up in a really big way. So, but the rest of the indices are overall strong. This is an above average volume day, which is what you want to see. It's trying to retake that line, that green line, that 20-day moving average. So I would be looking for that moving average to curl up a little bit, kind of curl back up like this, for the major indices to move back above it and see if you can ride it for a trend out of here. And that's just what the market does, and you really almost have to anticipate the shakeout. It took a double bottom right here, which I think most people anticipated, because if you've looked at market corrections, you know that it's typically going to take a second leg down. Just as you think it's coming out of it, kind of breaks this mini pivot right here. It just shakes you out one more time, stressing the living bejesus out of a lot of people, and then that's when it takes off. So it's really important to not ever to be too bearish or too bullish, and just be willing to just take what the market can give you. Don't try to revenge trade or make up losses. Whipsaw is a part of trading. It's just going to happen. But right now the Nasdaq is looking strong today. Hopefully that'll hold by the end of the day. Now, if we look at the S&P 500 right here, you can see, so the Nasdaq and it came up and broke to a 52-week high. S&P 500 did not. It was the weaker one. And you can see right here that it just came down to this trend line, touched the 200-day moving average yesterday, and then reversed. So you got a nice reversal, although it wasn't in volume that was as high as the previous day. And when you get distribution on the downside, you kind of want to see that right side. You want to see some accumulation days on the right side. So that's really a development that we're going to have to pay attention to. Have to pay attention to the accumulation and distribution days, because you don't want it to be, well, like this. It's all volume on the downside, not a lot of volume on the bounce, and then it just kind of cracks again. I've seen market uptrends go pretty nicely without huge volumes. So I follow the price first, I follow the volume second, but again, you want to see some accumulation stepping in. So, we're looking for the S&P 500 to break one of these trend lines. I tend to think it's going to break to the upside, just because I think that, right when everyone is just frustrated that it continues to break out. But I tend to think that it's going to retake and start a rally out of here. Maybe that's just because the market has a long-term upward bias. So even though you have these market corrections that can last from the end of January, we're still in it. We kind of fall back into the correction. We're not out of the woods yet. That has to happen. That's part of the market. That's part of the bull market. It takes nice trends up, and then it'll give some of it back. So the goal is to make sure you have rules to slowly get out and slowly get back in, and you're not trying to overtrade all this mess in between, because as you can see, when you get that first waterfall, it's really hard to catch a trend, right? And I trade growth stocks. We trade growth stocks. So, we're looking for a positive trend. It doesn't have to be this long. Most of them are not. But you're looking for a positive trend, a positive rally, and make sure that you have the right stocks in place to capitalize on that. And if not, if it's very short-lived, make sure that, you are taking a little bit of profits along the way, which is what I typically do. A stock might get to anywhere from 7 to 10%. I'll go ahead and sell half and raise stop to break even. By doing that, I'm guaranteeing myself a gain if the stock comes back and revisits the pivot to stop me out for a smaller gain. But the reason I don't take all the gains is because to outperform the market or to have a good year, you have to have some bigger winners in your portfolio. You're not going to smoke the market with a bunch of 5 to 7% winners. It normally doesn't work that way. You need one or two nice, really nice trending stocks to kind of help balance things out a little bit. So right now with the S&P 500, just really looking at this trend line, looking and seeing if we can have kind of a bounce, a nice little bounce. Right now, we're still in a market correction. It rolled back in. We're going to look at the breadth here in a second. I don't want to look at the weekly chart right now. Let's look at the small caps. Come on. Okay, so I want to look at small caps, Russell 2000. I do want to look at the weekly chart. It's a volatile indice. Small caps makes sense. It's at a similar downtrend, just like the S&P 500. But with the dollar trying to rise, the small caps have broke out relative to the S&P 500. So if we can get a rally out of here with a strong dollar, I think small caps are really going to lead the way and could double the S&P 500, just because that small cap leadership typically follows the dollar leadership. And right now it is holding this blue line, which is the 10-week moving average, looking like it just wants to knock on the door and bust through. And a lot of times that's going to happen. Like, you get slammed down, you come down, you test the trend line, you get slammed down. You can see it try to poke above, but it's going to shake you out one last time. And right when you think that it could crack to the downside, it's just going to bust through. So just don't get caught with your head in the sand. Just always be prepared for that next leg up. Make sure that you have rules to get you in the market. So I just want to tell you, though, coming out of correction, I have rules to get me back in the market. And every time I'm coming out of correction and I place that first trade, the rule that forces me to get in, it's just not a good feeling, because you just came out of a correction. And it's hard to think that the market a new uptrend is beginning. That's why you slowly get in and slowly get out. Something I learned from IBD. But you gotta have some buy rules to slowly suck you into the market. Let's look at the sector summary. Let's just kind of go out there and see what is strong. So today, Thursday, technology is strong, which makes sense because you have a lot of big tech earnings. Facebook is probably leading the way. Cyclicals, both positive, optimistic sectors. Industrial and financials towards the bottom, but I mean, they're not getting slammed. So right now, I'd say that's positive development. Let's go out and look at 1 month. So I like to look at the 1 month and the 1 week, kind of cross-reference to see if there is money flowing into something. And clearly, clear as day, energy is up over 9%. The XLE, it has now got the strongest scooter ranking on the last 1 month. Consumer staples, a lot of your dividend-paying stocks, your Kellogg's, your Phillips, cigarettes, the kind of recession-proof type companies, they're down, and they are the weakest sector by far. So these dividend-paying stocks, a lot of times, when interest rates rise, Okay, some of these dividend paying stocks, some of these safe companies, the dividend doesn't look as attractive anymore because of interest rates rise, so people start to find other areas of opportunity, other areas of growth, and they become out of favor. So I say, don't always think that your safe sector is safe, because it hasn't been performing well. Everything can go down, is what I'm trying to say. Energy, in the last 1 week, energy is up, healthcare is up. Actually, I'm going to click on healthcare real quick because now it's kind of got me wondering what is strong. So biotech, medical supplies, in the last 1 week, healthcare providers, medical supplies, I continue to see in the cross-reference. So, maybe that's something that needs to be investigated a little bit further. If I go into the energy sector, in the last 1 month is coal. You have exploration and production, oil and gas, equipment services. This is the industry. So you have the sector, which is energy, and you have the industries that make up the sector. You want to be the strongest stocks and the strongest industry and the strongest sectors. So let's go look at what's happening. So in the last 1 week, coal has been down, and exploration and production have been up. So I believe that's your XOP ETF. And so then I click on it to see all the stocks listed, and I look at different screens, so I don't go through here, but I mean you can. But what I look for is green and red, and I'm looking for, if there's money flowing into the industry, is there broad participation, or is it just a handful of stocks pushing it up? And there is some red down here, but I would definitely say there's a lot more green. I would definitely say there's more broader participation. So it's something worth noting, and it's definitely something worth paying attention to. It's not something you want to ignore. Let me go back to the dashboard. Let's look at market breadth. So energy, I mean, I've been kind of banging that drum for a few weeks. Let's look at the S&P 500 breadth. So this is S&P 500. This is the percentage of stocks above the 200-day moving average. Kind of my main focus, just to see, is the big trend up or is the big trend in correction. It's really still in correction, which would follow the price action. The price action broke out, rolled back over, but is a couple days away, a stone throws day away from breaking out of this downtrend. So really just keep that in mind, that we could be a week away from just resuming. But the percentage of stocks above the 200-day moving average are at 57%. I'm sure that'll curl up after a nice day today, because this is kind of lagging a little bit. But it's just really been chop kind of correction type activity. So we popped above it, which is bullish, and then we popped back below it. So just part of the chop. So right now I'd say we're still in a correction, but I truly and honestly believe we could be 1 to 2 days away from getting out of it. So it's just something I learned. I just try never to be too bearish, because it's just, you're only a couple days away from a new uptrend. Let's look at the TNX. Where is that? There we go. Okay, we got too many charts. So the treasury yield, the 10-year treasury yield, this chart goes back to 74, peaked in 81. I'm sure if, for my older generation, you probably had some very high mortgage rates back in the early 80s. Yields have been going down for the last 40 years, 38, whatever. And when yields go down, bond prices go up. Okay? They have an inverse relationship. So we've been in a bond bull market for almost 40 years. Well, the tides are turning, and they don't turn quickly. This bottoming pattern has been in place since 2011, but we broke 3 either 2 days ago. Now we're at 2.996. So yields are breaking out of this 7-year bottoming consolidation. Looks like a head and shoulders. That puts us, I believe, in a new secular bull market for treasury yields, which could put us in a new secular bear market for bonds. So it takes me back to a story, and I probably told this before. When I was a financial advisor and an asset manager, I had a client that never wanted to invest in bonds because he had never He was probably in his mid-40s. He had never had a down quarter, is what he told me. And then what I told him is that's because you have always been in a declining interest rate environment, meaning you're in this long secular bull market in bonds. And when that ship turns, now I probably told him this back in 2012, so it was a few years back, but I said, you know, when that ship turns, your bond portfolio, the unlimited quarters of positive earnings growth, or excuse me, you know, net gain, is probably going to go the other way. So, and that's just something to consider. That's why, you know, a lot of times in the latter end of the business cycle, you have, you know, interest rates rise, inflation kicks in, commodities come, follow it, which we're seeing that already. So, all just something to consider. You know, most people have IRAs. They have these balanced portfolios, and I'm not telling you to go out there and sell bonds. I'm just at all, because then you're adding a more riskier portfolio. I'm just saying, be aware of, you know, the kind of market you could be in, and you know, take advantage sometimes of market dips, which I think that we are in now. If you're looking at some companies that you want to own for the next 5 to 10. Take advantage of some market dips, because there's some opportunity there. So if I go, so treasury yields are on the up and up, right? That's happening. I'm going to show this dollar to CRB chart, which I'll show this chart. I like this chart just because you have the commodities index, which is an inverse relationship with the dollar. Dollar goes up, commodities goes down, and vice versa. Well, you had the dollar really touching this 7-year trend line, excuse me, in a deep, deep bear market. And now it just broke out. We're going to look at a better chart here in a second. You had commodities so this was looking toppy, and it broke, right? It broke this trend line right here. Commodities index made up of oil, all your commodities, steel, was looking like it was an inverse head and shoulders, and is grinding its way higher. So typically, and it's not every week or every day or every month, you know, these are going to have an inverse relationship. So what I'm interested to see now that the dollar is headed higher, is this a counter trend rally, or is this the start of a new trend, right? Is the trend completely going to change? If that's the case, it would have a negative effect on commodities. However, I caution you to, you know, make too much trading decisions, you know, in oil or gold based on what the dollar is doing, because the dollar can rise and gold can rise at the same time, even though most of the time they're going to have a negative correlation. So all I'm saying is, you know, if you're don't go out there and sell all your commodities, keep the strongest ones, and if some start to look weak, then you can take action then. So follow the price trend first. You know, you can look at the relationships to kind of see what is going on out there, but whatever you own, always follow the price action of that asset or that sector, and you don't have to, you know, sell one sector just because another sector is moving and they should have a negative correlation. Because I've seen these correlations, and I've gone back, you know, back the last 30, 40 years, and they can, you know, move in tandem when they should be moving opposite for a couple years at a time. So if we go down here, the USD, a weekly chart, that is clear as day. You have the dollar, you know, broke out of this downtrend, broke out of this downtrend, and is now headed higher. So again, it goes back to, are we going to have just a retracement? Is this a counter trend rally, or is it going to go up, retrace a little bit, create a base, and then continue to go the other way? That is still out, but right now the dollar is in at least a short-term uptrend, which is making the S&P 500, which a stronger dollar typically leads the U.S. markets over international markets. You can see right here the S&P 500, the relative chart versus emerging markets, broke out relative to emerging markets. That means S&P 500 is now outperforming emerging markets. Same thing with the All World Index XUS. It broke out, kind of failed. Now it's probably going to break out again. And small cap leadership follows the dollar. So this is the small caps versus the S&P 500. broke out, as we saw on a previous chart, and small caps are looking stronger because the dollar's looking stronger. So plenty of confirmations going around, and we'll just kind of have to wait and see. Always, follow the trend until it's no more, So, because you never know how high or how short it can go. The most recent rally in the Nasdaq and the S&P 500 was not really a rally. It lasted about a week and then rolled over. So, but it could have lasted 4 to 6 weeks, and if you'd have sold too early, you'd probably be pretty upset with yourself. So, just have the rules to make sure that you stay in as long as you can. Okay, let me go to a different chart list. Let's go to the gold chart because everybody loves gold. And there's a lot going on in this chart. I like it because there's a lot of action. The GLD, we'll start up here. The GLD ETF, the gold ETF, broke its downtrend line. Makes sense. The dollar broke out, gold broke down, inverse relationship confirmed. Okay? So now we're following the miners. So now you got the gold miners that are right now they're in the middle of this long-term trading range. So right now they're doing nothing, right? They're just in this, hole of a no man's land. So, but it's riding this trend line. I think that if the gold miners breaks this 22-24 area, this pivot right here, I think that'd be probably not a bad setup for a gold short. Because if the dollar's strong, gold, the metal breaks the trend line, and then gold miners break the trend line, that's, I don't know how much more confirmation you want. But what's interesting about all that is this is the relative ratio to GLD, gold miners versus GLD. Something I learned from Greg Schnell at Stock Charts is he likes to own gold when the miners are outperforming the metal. So you can see right here this downtrend line. Then all of a sudden the miners broke out relative to the metal, and then we go up here to GDX and made a nice rally. Same thing over here. Even though it was a little shorter lived, the gold miners broke out relative to the metal and had a little rally. Right now, it's holding this breakout. You can see it broke out of this horizontal and it broke out of the downtrend line. And you can draw this trend line in another place where you could argue that it hasn't broke out. But either way, it broke out of the horizontal trend line, and now we're kind of waiting to see what it does. It's interesting that this is starting to curl up where miners are outperforming the metal, but the metal's breaking down and the dollar's going up. So I tend to think that this won't hold. If you just kind of look at, I have 2 strikes. You got 3 strikes, or 3 things happening. You got the dollars going up, confirmed. You got the gold going down, right? Broke out of downtrend, confirmed. So that's 2. But the miners are still outperforming the metal. So you got 2 out of 3 in the gold bear camp. But again, you might as well wait for that extra couple points to the downside confirmation. You can see this is the UUP down here. It broke out of this right here, 2375 area, and is moving higher. So an interesting potential for a gold miners or a gold short. That low is 2237. That's the pivot I would probably look to see if it breaks. But again, keep in mind, even if it breaks this, it could find support down here where it's found support for the last almost 2 years. So it's might not be like The Big Short. The movie where everybody makes a lot of money on a huge short. So actually I want to go back. I want to look at the XES, the Oil and Gas Equipment Services. You have West Texas Intermediate crude up here. Broke out, tested trend line, hit higher. Looking like it might be a little exhausted, but at the end of the day, West Texas is at $68. That's a long way from the $20 and change, or when it was under 30 a while back. So it's came a long way off the bottom. I'm sure the Middle East is happy. So here's what's interesting. Okay, so speaking of relative charts, you have the XES versus West Texas relationship. It broke out of its downtrend, meaning oil stocks or at least this oil ETF, is outperforming West Texas. That's a positive, right? And then you have a strong trend out of this breakout. Still kind of just hovering around. This could just kind of looks like one big head and shoulders, but you know, I'd say right now it's in an uptrend, a strong uptrend, a little extended. So I'm not telling you to go out and buy this right now. I might look for a retracement on this one. But with the XLE being the strongest scooter ranking of all the 9 sectors, you know, breadth is getting stronger, oil is high. The trend is up, right? And you want to trade with the trend. So a little extended, but a retracement wouldn't be a bad entry. We own some oil stocks, or a oil stock, and we're just hanging in there. It's doing okay. We're going to hang in there until it proves us otherwise and take some profits on the way. But here's what I kind of want to show you. So you have this RSI 10. You got to be careful on if you got a good price on selling something too early. You probably want to sell as it's coming out of the overbought instead of heading into the overbought. Because if we look at this right here, actually let me move this up. Can I? Yeah, let me move that up one. Let me update it, just so we can kind of have all this all on one chart. Okay, so you know, it comes out of oversold, which is not a bad entry of the RSI 10, and then it heads into the overbought. Well, if you would have sold it as it entered the overbought in an uptrend, you would have sold way too early. If you would have sold it as coming out of the overbought, you'd have timed it pretty good. Okay, so you sell it here, buy it as it's coming back out here, pretty good entry. Sell it here. It's not perfect. You had a little whipsaw right here, so you probably more want to look at coming out of oversold versus coming out of overbought. So you would have sold right here. You probably would not have gotten back in because it didn't get oversold again. But if you did, again, look at this, a little bit of whipsaw, but if you just are used to selling stuff as it's getting oversold or overbought, it can stay overbought for a while. Whereas look at this bar right here, right as it was coming out of overbought. Not a bad profit taking rule right at the top. I mean, it's just something to look at when you're in kind of more of a correction mode. You know, it's good to back out the RSI to RSI 10 so you get less signals. Versus an RSI 5, and if you would have came out of this, you probably would have lost a little bit of money. At least I know I would have if I would have bought out of this over sold, because I would have, you know, put my stop in right below here and it came all the way down here. It would have stopped me out. But again, you look at this, and my point is to stay with the trend until it is probably close to over, and don't take your profits too early. Because you need some good winners in a portfolio to really help make your year. And you can look down here, the oil stocks broken out relative to the price of oil. So with that being said, I want to move over and change directions a little bit. And we're in the middle of earnings seasons. I am always, every single weekend, I'm looking at earnings reports, earnings gap ups. I'm looking for volume. And that's why I'm focusing on earnings and volume scans, because typically the kinds of volumes that are coming into powerful stocks, it takes institutional money to create those volume spikes. So I'm just looking to ride the coattail a little bit. Okay, so I'm in an earnings gap up scan, and it doesn't really matter. This is just a charting service. It doesn't matter what broker you use. They pretty much all have earnings gap ups. Earnings scans, earning gap up. I mean, it's just a good place to look right here. So let's look at this for a second. I'm just going to start at the top. I have not looked at this list before this webinar. I'm just going to start at the top, and I'm just going to show you kind of part of my weekend routine. You know, so I'll look at the earnings gap up. That's pretty interesting. I don't know this stock, ARD, but it broke out. I was trying to break out of this downtrend. It looks pretty solid to me. You can see right here, not really above average volume. I see when I look for an earnings gap up, man, I'm looking for the volume to step in. So, maybe it will, but it's above average for the week. But this it probably will be something I pass on, just because if I'm looking for an earnings gap up, I want it to be 2 to 3 times above average volume to show real power. All right, let's just continue to go down the list. Again, this is just kind of an ugly looking chart. I'm going to pass. Okay, so fiat, you got a little volume stepping in, and this is above average volume, but the day is just not that spectacular. You can see that it's got a cup with handle. It tried to break out, but it's just kind of meh. And I can comb through these pretty quickly. This kind of looks interesting. CSTM. So you can see that the chart, it pulled back. It's trying to break out of the downtrend. I would probably wait and see if Friday and Monday it has some follow through. But it's got, over double the volume. It's trying to break through. I'm guessing that this line holds as long as the market holds up. But this could end up being kind of a weekly reversal right here. We'll just wait and see. So looking at the sales right here, you got some acceleration on the sales for 1, 2, 3, 4, 5, 6, call it 7 straight quarters. I mean, that's pretty strong growth right there. So someone's stepping in. This is a steel stock, but it's probably also choppy. So just kind of continue to look. CVR refining. Let's look at it. It's got a pretty low return on equity. So what I do is I kind of give it the eye test, right? I look right here, I look down here, and then if it passes the price test, it passes the volume test, then I'm going over to look at the fundamentals. This stock is pretty extended for me, and the volume isn't even huge. So yeah, this is going to go straight up. If I were a betting man, so you got these deep cups, right? If I were a betting man, it's going to get to this point, and then it's going to pull back all the way to this 20-day moving average. So it's going to break out, it's going to shake out, create a real high handle. But someone's stepping in. You can see all these days up in a row. So that's someone's big stepping in. So I wouldn't be against looking at a pullback right here, but we'll just kind of keep going. All right, so AbbVie, I kind of like this one right here. You have pretty nasty sell-off right here, and now it's trying to start to climb the right side of the base on this earnings gap and above average volume, hovering around the long-term moving average. Let's look at the fundamentals. You can see it has 4 straight quarters of sales growth. 6 straight quarters of earnings acceleration, excuse me. That's acceleration from 6 to 11 to 13, so when the numbers are higher. So I look at acceleration, not necessarily growth, because I want something good to be happening on the fundamental side. Very strong return on equity. This is something that I think I will put on the watch list for, I'll probably watch it for a day or so. Bloomin' Brands, restaurant. So I don't really like it. I'm just kind of looking at it right here, and I'll tell you why. So let's just go to this. Just a lot of tugging and pulling. So yes, it's gapping up pretty good on earnings today, but man, I like a little bit neater, and this is just sloppy. And then when I go to the fundamentals, there's nothing sexy about negative sales quarter after quarter, so I'm going to move on. Facebook, very interesting. Boy, that's a gap if I ever seen one. It's got a nice, that's for a large cap, it's a pretty good gap. Yeah, I would look for this gap to fill, and that might be your entry a little bit. Maybe, and it probably doesn't. Institutions, this is a stock they can get in and out of. But it had a really, from 195 to 150, a 25% correction. That's hardly a correction, for growth stocks. But, it still held up okay. Volume's been stepping in. Buyers have been stepping in. I'll watch this. Here's why I'll watch it. One, it's got a nice gap up, 10%, nice volume. So it passes the price and the volume test. Then I'll go over here and looking at the fundamentals. And it's got acceleration year over year, 17 to 21%, and a 27% return on equity. So here's what I look for. When I look for fundamentals, I really like year over year acceleration. I pay some attention to quarterly, but you know, some stocks have seasonal earnings, so I try to just look at the annual. It just makes it simple. And if something is expected to, the earnings are expected to accelerate next year, that's something I really look for, because a lot of times the institutions are going to price next year's earnings potential in this year's price, because it's always forward looking. So with the return on equity, boy, I'd like to get this stock a little cheaper. And this, you know, just me personally, I could hold that for a long time. Just kind of forget about it, because you know, there's still nothing as far as Facebook goes. Their advertising platform in the digital world, there's no one that can compete with it, because, well, all the data they have, really. So that's a pretty good gap. Suncoke Energy, coal, you know, probably just a little too sloppy for me, but I would probably watch that, because all of a sudden you got some sales growth here, some spotty earnings, but I'll probably watch it. Let's go through a few more just to see what we can find. And a lot of times I don't know what I'm looking for. I'm just looking for charts. This looks interesting. First Interstate FIBK. This is why it looks interesting. It's not really that sloppy looking. It's breaking out of a downtrend. It's holding the long-term moving average, and it's got some massive, massive volume. Look at that. I might add this to Swing Trade Ideas. I'm not telling you to go out and buy this. You know, I'm just adding stuff to watch. I'm just building my watch list. So every weekend I'll just go through, probably a few hundred charts. I could be anywhere from a few hundred to over 5. And I'll add a few, and then whatever charts on my watch list look ugly for the week, I'll get rid of them. You know, earnings are okay, but banks aren't really a sexy industry. You're not really going to get a lot of that triple-digit type earnings. You know, if you can get double-digit, 10 to 20% earnings growth consistently, a return on equity above 10, that's pretty good for fundamentals for a bank. And this looks like it reversed the other way. Yeah, not interested, because I'm looking for gap ups, not gaps and reversals. Again, this kind of looks a little ugly. You can tell it tried to break out of this handle right here, and it just got slammed back down. So somebody pretty big is selling into this right here. You can see all the resistance at $13, and it happened again. Wow. Beats. This is something we made money on earlier this year. Okay, let's check this out. So you have a rising relative strength line. You got a very, very nice earnings report, 144%. Let's check out the daily chart. Broke out clear as day out of a cup with handle on massive volume. Triple digit, 300% above average volume. It's up pretty big. I wouldn't buy it here, but that's power. So that is going on a list. Then if I go over to fundamentals, I'll go look at the last, 4. So 10 to 53 to 70 to 69. That's an acceleration. Pretty good return on equity. Not acceleration, but it looks like the green arrows means that the projections are moving up, so that's positive. 3 straight quarters of earnings acceleration. Something to put on a watch list. I'm not telling you to go out and buy this stuff, full disclosure, but something to put on a buy list. So, again, I continue to get asked all the time, like, what do I need to be doing to continue to be a better investor, a better trader? I don't think there's anything that can supplement just going through chart lists and just being as observant as possible. You don't have to know what you're looking for. Just try to be observant and and learn, you know, how the movements of stocks work and learn how each stock has its own personalities. It takes practice, but it's a skill that once you start to get the hang of will really, really help you. If you're not a paying member of the Traders Plan to my subscribers to get the stock picks and all the courses that come with that, I highly recommend you going ahead and doing so. We have some stocks that are holding up pretty nicely in this market correction, and one that I think is going to be a big winner. Shall see. So you can probably find a link in the bottom of your email. Click that, take a trial, and come join us. Let me know if you have any questions. I hope everyone has a wonderful, wonderful rest of the week.